Imagine having only 10,000 in your pocket, but being able to control a 100,000 investment. Sounds impossible. It's not. Some of the wealthiest people and most powerful companies in the world do this every single day. They don't wait until they have enough money. They use other people's money to grow their own. That strategy has a name: financial leverage. And once someone understands how it works, it changes the way they think about money forever. Most people believe that to build wealth, they need to save every dollar and spend nothing. But the rich follow a completely different playbook. They use borrowed capital as a tool. They put it to work, generate returns that exceed the borrowing cost, and pocket the difference. That's the core of financial leverage, and it's simpler than most people realize. What financial leverage actually means, at its most basic level, financial leverage is the practice of using borrowed money to fund investments or business activities with the goal of earning more from those investments than the cost of the debt itself. In other words, someone borrows money, puts it into something productive, earns a return on the full amount invested, then pays back the loan and keeps the profit. Think of it like a lever in physics. A small amount of force applied at one end can move a much heavier object at the other. In finance, a small amount of personal capital, combined with borrowed funds, can generate returns that would never be possible using personal savings alone. Here's a simple example. Suppose someone has 20,000 and wants to invest in a property worth 100,000. Instead of waiting years to save the full amount, they use their 20,000 as a down payment and borrow the remaining 80,000. If that property rises in value to 130,000 and they sell it, the gain is 30,000, not on 100,000, but on the original 20,000 they put in. That's a 150% return on personal capital. Without leverage, the same 20,000 invested directly would have produced only a 30% gain. That's the power of leverage at work. Companies use this strategy constantly. Tesla, in its early years, relied heavily on debt financing to fund research, development, and production scaling. Elon Musk and the Tesla team didn't wait to be profitable before expanding.
Well, I wouldn't, for the prototype at least, I would recommend not dropping anything when you're near.
They borrowed aggressively, used that capital to build factories, develop electric vehicles, and grow their brand. The debt was a calculated risk, and it paid off. Tesla eventually became one of the most valuable car manufacturers on the planet. Without leverage, that growth trajectory simply would not have been possible. Apple took a slightly different angle. Despite sitting on enormous cash reserves, Apple chose to issue billions in bonds and take on debt. The reason? Interest rates were low, and borrowing was cheaper than using their own cash. They used those borrowed funds to buy back shares and deliver dividends, boosting shareholder value without giving away ownership. It was a masterclass in strategic leverage. McDonald's has also used leverage brilliantly. The company borrowed money to fund global expansion and franchisee support, building a cash flow machine that now spans over 100 countries. The leverage allowed them to grow far faster than they could have on equity alone. There are different types of financial leverage worth understanding. Operating leverage involves a company's fixed cost structure. When a business has high fixed costs, small increases in revenue can lead to enormous jumps in profit. Financial leverage, in the more specific sense, involves debt. Combined leverage is the combination of both, and it creates the highest potential for reward, as well as the highest risk. How financial leverage amplifies returns and losses. Here's where the story gets more nuanced. Leverage is not a guaranteed path to riches. It is a double-edged sword. When things go right, it magnifies gains beyond what anyone could achieve with their own money. When things go wrong, it magnifies losses just as powerfully, and those losses can spiral out of control very quickly. To understand this clearly, imagine two investors. The first invests 50,000 of their own money into a business and earns a 20% return. They walk away with 10,000 in profit. The second investor puts in 10,000 of their own money and borrows 40,000. They invest the same total 50,000 and earn the same 20% return. After paying back the loan with interest, they still walk away with a significantly higher return on their personal investment. The leverage multiplied their results. Now reverse that scenario. The investment drops by 20% instead of rising. The first investor loses 10,000 out of their own pocket. The second investor loses the 10,000 from the investment, but still owes the full loan plus interest. the personal loss is proportionally devastating. This is why financial leverage is often described as amplifying everything: the wins, the losses, and the risk. Companies that over-leverage themselves often face severe consequences during economic downturns. When revenues fall but debt obligations remain fixed, businesses can quickly find themselves in financial distress. The interest payments don't pause during a bad quarter. They must be paid regardless of performance. This reality forces highly leveraged businesses to maintain strong and consistent cash flows or face serious trouble. Lenders are also fully aware of leverage risk. When a company's debt-to-equity ratio climbs too high, banks and financial institutions become more cautious. They are less willing to provide additional financing, and when they do, they charge higher interest rates to compensate for the increased risk of default. This tightening of credit makes it even harder for over-leveraged companies to recover during difficult periods. Elon Musk himself has experienced leverage risk firsthand. During his acquisition of Twitter, rebranded as X, he used significant amounts of debt to finance the deal. The resulting interest obligations placed enormous financial pressure on the company, leading to public discussions about its financial stability. Even for the world's wealthiest individuals, excessive leverage carries real consequences. The key lesson here is balance. Financial leverage is a powerful tool when used wisely and proportionally. It requires a clear understanding of expected returns, realistic cash flow projections, and a careful assessment of what happens if the investment underperforms. How smart people use financial leverage wisely. The difference between those who benefit from leverage and those who are destroyed by it comes down to one thing: discipline. Smart investors and companies don't just borrow money because they can. They borrow strategically, with a specific plan, a defined return target, and a clear exit strategy. The first principle of smart leverage is ensuring the expected return exceeds the cost of borrowing. If someone borrows money at an 8% annual interest rate, the investment must realistically generate more than 8% to make the strategy worthwhile. Any less, and the leverage is working against them. The second principle is cash flow awareness. Debt must be serviced, meaning regular payments must be made regardless of how the investment performs. Investors and businesses that use leverage need to ensure they have enough reliable income to meet those obligations without strain. Running out of cash while carrying debt is one of the most common causes of financial failure. The third principle is knowing when not to leverage. Not every investment is suitable for borrowed capital. Assets that are volatile, unpredictable, or illiquid carry a much higher risk when combined with leverage. Real estate, in many markets, has traditionally been a strong candidate for leverage due to its relative stability and income-generating potential. Highly speculative investments, on the other hand, can become extremely dangerous when debt is added to the equation. Warren Buffett, one of the greatest investors of all time,
I set out to do, and actually that's what impressed Charlie when I first met him, because I knew all the details.
has spoken extensively about the dangers of excessive leverage. His approach has always been conservative when it comes to debt. He has acknowledged the seductive power of borrowing to amplify gains, but has consistently warned that leverage can wipe out even the most brilliant investor if the timing is wrong. His own company, Berkshire Hathaway, uses leverage selectively and always with a heavy emphasis on long-term stability over short-term profit. Robert Kiyosaki, author of Rich Dad, Poor Dad.
And I have boxes of gold. I own gold mines. I've taken 2 gold mines.
Built much of his financial philosophy around the concept of using good debt to acquire income, generating assets. His framework teaches that leverage, when applied to assets that produce consistent returns, is one of the most effective tools for building long-term wealth. The distinction he draws is between bad debt, borrowing for liabilities, and good debt, borrowing for assets that pay back more than they cost. Financial leverage, at its core, is not magic. It is math combined with strategy and timing. When someone borrows money at a cost lower than their expected return, applies it to a productive asset, manages the cash flow carefully, and prepares for downside scenarios, leverage becomes one of the most powerful wealth-building tools available. It is how ordinary people buy extraordinary assets. It is how startups become corporations. It is how small ideas become empires. The goal is not to be afraid of leverage, it is to respect it. Used with knowledge and discipline, Financial leverage doesn't just multiply money, it multiplies possibility.